Welcome back to Stock Entry Exit Profit. In today's video, we're diving into Laxmi Organic Industries Limited, a specialty chemicals company that's now trading near its 52-week low. The stock's around 172, and with the broader chemical sector still weak, the big question is this a value opportunity or a value trap? Let's decode that with a clear, data-backed breakdown. Laxmi Organic operates in acetyl intermediates and specialty intermediates, serving key sectors like pharmaceuticals, agrochemicals, coatings, and adhesives. Their major products include acetic anhydride, ethyl acetate, and specialty ketones. They have integrated manufacturing plants in Maharashtra and Gujarat, supplying both domestic and export markets. The company is gradually shifting from commodity chemicals toward higher-margin specialty products, a strong positive for long-term investors. But remember, this is still a volume-driven, margin-sensitive business, heavily tied to the chemical cycle. If we look at recent quarters, revenues have remained flat to moderately positive, while margins are under pressure due to weak global demand and volatile raw material prices. The company is in the middle of a heavy capex phase, expanding capacity and investing into specialty chemicals. That means short-term ROCE looks weak, but that's largely due to capex digestion rather than structural issues. Debt levels are slightly elevated compared to earlier years, but remain manageable, so the current earnings are suppressed by the down cycle, not by poor fundamentals. Now, let's talk about the positives. Laxmi Organic holds a strong position in acetyl chemistry, where entry barriers are high. The company's expanding specialty chemical portfolio supports better long-term margins. It also enjoys a diversified customer base with strong export capabilities and integrated facilities that help control costs. Once the chemical cycle turns up, profits could recover sharply due to operating leverage. Of course, there are risks too. The specialty chemical cycle remains weak, and recovery timelines are uncertain. Margins can be volatile because of raw material price swings. With ongoing capex, ROCE may stay muted for a few more quarters. Plus, since the stock is near its 52-week low, market sentiment is clearly cautious for now. From a market view perspective, the current price, around 172, is very close to a major support zone between 165 and 175. For short-term traders, a breakout above 195 with solid volume could be a signal for fresh entry, with potential targets around 215 to 230, and a stop-loss near 162. For long-term investors, the accumulation range of 165 to 180 looks meaningful, with possible upside targets of 260 to 320 plus over the next 1 to 3 years. The key is patience. Keep adding gradually as specialty chemical revenues start scaling. So to wrap up, Laxmi Organic is a classic chemical cycle stock, temporarily out of favor but standing on solid fundamentals. The valuations are now offering comfort for patient long-term investors. Short-term traders can wait for trend confirmation, while investors with a longer horizon may consider accumulating near support levels. If the chemical sector revives, Laxmi Organic could see a strong re-rating in both earnings and valuation. Thanks for watching. If you found this analysis helpful, make sure to like, share, and subscribe for more value investing insights every week.